But my first guest, well, she connected the dots. In fact, she sent out this warning flare. Diane Swonk warned in a July 6th tweet, the ice is thinning. Red flags are emerging. Joining me now, KPMG, their chief economist, Diane Swonk. You know, Diane, the better part of valor has always been the big question here when it comes to the Fed. Should they be too early or too late? That's actually being tested in real time right now. You sent out this warning flare. What are your thoughts now that it's coming to fruition?
Well, I think the Fed's feeling a bit of remorse that they didn't actually cut at their July meeting this week, and they even discussed it. So that's one issue. Are we headed into a recession? No, I don't think so. Claudia Sahm herself has said her rule is not really applicable anymore. And we know that the household survey was distorted not only by the fact that it's 2 years behind on demographics, and it's shown no increase in employment in a year. We've seen 2.5 million new paychecks added to the economy, and we've seen consumers spend. So we're not in a recession. That's the good news. But it does give a warning shot to the Fed. They do worry about unemployment rising slowly, then rapidly. I think some of this is Hurricane Beryl. It really did affect Houston, and we had over 1 million people that were the week of the survey without power, and businesses were down. The layoffs were highest among those that were low-wage workers with a high school degree or less. That is bad news. On the flip side of it, we also saw that unemployment rate rise because more people entered the labor force and were looking for a job and seeking work, and the participation rate moved up a bit. So that was good news. At the end of the day, I think some of this will wash out, but the Fed is already getting the benefit of lower interest rates that are going to stimulate the economy and help create a floor under the economy in the third quarter. I think the third quarter will be the weakest, and they'll be cutting by 0.5% in September.
Now, what happens, because for the most part, almost every economist I bring on, you know, everything's hunky-dory, even when the numbers aren't. You know, there's always reason to ignore it. Maybe it was Houston this time. But do we ignore what we see with manufacturing PMI, services PMI, both under 50? And also, you brought up the lower income brackets. You know, I think a larger swath of this nation is hurting, and it's hard to see it when you just look at aggregate data. Right? The rich are doing extraordinarily well, but I think more and more people, they're telling you they're hurting. And this is what I don't get. Like, people are saying, I'm hurting. I can't pay my bills. I'm suffering. And most economists are saying, no, you're doing great. You know, buck up. Don't worry about it. It's going to be okay. And the Fed's got to deal with that. You know, every time the FOMC, when Jay Powell steps to the mic, he finishes his last statement, always says that we know our actions affect the public. But it feels like the overwhelming majority of the public, that their voices and their economic concerns aren't being heard or felt when it comes to policy.
I don't think that's true. I do think I do know that Jay loses sleep over this at night. So this is really important to them. They are taking it very seriously. But you bring up a really good point, and I want to expand on it because I think, you know, it's important to understand the difference. The economic aggregates, they summarize the economy for everyone, but really tell it the experiences of no one. And I think that's what's important here is once we disaggregate the data, we do know the bottom 30% of households, they've run out of the cash that they had amassed, and they have less savings than they did pre-pandemic. They don't have any cushion. The cumulative effect of inflation, even as it cools, is still hurting them because price levels are too high. That means we need to see more rollbacks, more discounts in prices, which we're beginning to see now. I'm encouraged by that. Why did consumer spending pick up in the second quarter? Because consumers pushed back, but they didn't pull in when retailers finally rolled back prices a bit. It's not enough. It's a beginning. But these are the kinds of things exactly the Fed needs to see to move forward. I do think they could have cut in July. I think they're probably second guessing themselves on that. But we're getting that stimulus now, and that's the good news. And ultimately, it's the Fed's job to get rid of this inflation to the point that it's no longer top of mind for anyone without tipping over the apple cart.
You know, I think the last 2 weeks, one of the things that's stuck out for me is just from corporate America. You know, and I like corporate America, honestly, better than surveys. You know, and when I look at a company with businesses in every single state and, you know, tens of thousands of employees, and they've all, whether it's Louis Vuitton or it's some deep discounters like a Five Below, which said it's just a disaster. You know, yesterday Wayfair brought up the great financial crisis. So I am concerned, but I do also want to get your expertise on this because most Americans aren't sure why it's happening, but apparently our connection with the Japanese market, the so-called carry trade, Japan's market is absolutely imploding. Something's going wrong there. How concerned should we be that that's over-influencing our markets?
I think it's actually we're influencing them. The problem for them is that they've got inflation. They think inflation is coming down. The Bank of Japan thinks it's coming down. They got a lot more debt than we do, so raising interest rates has a lot more consequences on that debt service burden for them. But they're waiting it out at a time when the Fed has also waited it out on cuts here, which has meant depreciation of the yen, a sharp depreciation of the yen, which could be more inflationary for Japan down the road. And it's a really tough spot for Japan to be in. And financial markets would like to see the Bank of Japan actually raise rates because they've got higher inflation. They've seen wages pick up. They also know there's a cliff coming. In Japan, many people who are over 60 are forced to take a cut in pay. And they've got a lot of people turning over 60. That's a cliff that is going to help to slow wage gains for Japan. So they're sitting there saying, we've got our own situation, but it is having spillover effects because the Fed is a de facto central bank for the rest of the world.
Yeah, and that demographic thing is, we can talk about that forever. I think almost every advanced economy has a demographic problem that someone needs to figure out a way to address. Well, Diane, we thank you for the warning. Yeah, I know. And we're not having enough kids. We need more kids. Anyway, you're fantastic. I really appreciate you coming on. And again, I just wanted to give you credit because you called this, and I'm glad you're a voice of calm right now. Thank you very much.